at the IFA, the International Franchise Association, and I have another special guest, happens to be a fraternity brother. You'll notice he's much, much younger than me. Up next.
The way that we like to think about it is our goal as fiduciaries and wealth planners is to maximize and enhance those first three buckets while minimizing, obviously legally, that fourth bucket. Because I have yet to meet a business owner, as I'm sure you have, who's looking to give more money to Uncle Sam at the end of the day. Come up with an idea of what their business is worth, purely based on their heart.
We call that the dartboard.
Yeah.
And the key advice here is that you need to be prepared. It's just like doing your taxes. Hopefully you're not doing them yourself. This episode's sponsored by SEO Samba. Empower your franchise with predictable results and AI-driven marketing. Dan Axelrod is a VP. He's a wealth advisor, but he's the VP at Bernstein Wealth Management. Dan, so I'm excited to have you here. We've talked before. We talked about how wealthy franchise owners, business owners exit.
Yeah.
And are they prepared? Are they not prepared? So why don't you talk about what is Bernstein? I understand you're a fiduciary. It's not just some wealth management person just picking stocks for you. So talk about all that.
Yeah, absolutely. So Bernstein is the private wealth management arm of AllianceBernstein, which is a global investment manager that manages approximately $800 billion of assets around the world.
That's it.
It's a small amount. And where I sit in the private wealth management group, we manage about $130 billion of assets for some of the wealthiest individuals and families throughout the US and the world. At Bernstein, we operate as fiduciaries, as you mentioned, for all of our clients and have since our founding since 1967, where we have one particular focus, and that is on our clients and actually investing on their behalf. So because we have just that one line of business, we're able to really kind of avoid all the potential conflicts of interest that a lot of the larger financial institutions naturally have just through their massive size.
Yes.
And myself as a wealth advisor, I focus on working with business owners of all types, but particularly with multi-unit franchisees and franchisors on pre and post-transaction planning around an exit from their business.
So Dan, you mentioned pre and post-transaction planning and essentially keeping more money in the client's pocket. What does that really mean and how do you do that?
Yeah, so the way we see it is there's really, four buckets in which your financial capital can go. You can either spend it, you can give it to loved ones, you can give it to charity, or you can give it to the government via taxes.
Oh, excellent. Give it to the government. But isn't that essentially what people do? I had a gentleman that owned a famous pizza concept, and he told me he's going to exit for X amount of millions of dollars. He had zero planning. And I said, why do you want to give all your money to government? He goes, what do you mean? I said, there are options on how you can not necessarily avoid it, but what do you call it? You don't want to say you're avoiding taxes.
Yeah, the way that we like to think about it is our goal as fiduciaries and wealth planners is to maximize and enhance those first three buckets while minimizing obviously legally that fourth bucket. Because I have yet to meet a business owner, as I'm sure you have, who's looking to give more money to Uncle Sam at the end of the day.
Dan, what are the top two things you must do before exiting your business?
Very, very good question. So number one, making sure your financials and your books and records are in good order, because number one, that's going to allow you to get a reasonable and valuation that is actually accurate. But number two, the due diligence process that a buyer has to undergo when examining your business to ensure that they're paying what they feel is a fair value for your business, that enables them to do that as quickly and efficiently, as cleanly as possible. So that's number one. Number two is make sure you have the right team in place, because so many folks might be working with the accountant that they have had for the last 15 years or the wealth advisor they've had for the last 15 years. You need to make sure you have the right team who can handle the complexity of, number one, the transaction, but the burdens that you're going to have from this wealth post-sale. So you need a CPA to handle your personal and business tax. You need a trusted estates attorney who can enable that, ensure that your personal balance sheet is structured in the most efficient manner possible from a income tax and estate tax planning aspect. You also need a wealth advisor who specializes in exit planning as well.
What are the top three things that people most often mess up when exiting or selling their business?
Yeah, I think that the first that I've seen the most is someone will come up with an idea of what their business is worth purely based on, their heart.
We call that the dartboard.
Yeah, that too. But I mean, if you think about it, your business is your baby and you assign so much value to that. So having this sense of what it's worth versus, taking a deeper dive and understanding, well, how much do you actually need from a transaction to fund your lifestyle, to accomplish what you want to accomplish with this newfound wealth? Because, for example, you could say, well, I think my business is worth 50. That's what I want to sell for because my neighbor just sold his business for $50 million. Well, that could be two totally different industries that have nothing to do with one another. And you might be getting offers at 40 or 45, but saying no because you have this number 50 in your head. But if we backed into it and did the math, which is the analytical work we do, turns out you really only need $30 or $35 million to fund your lifestyle and your philanthropic and legacy goals. So you're leaving really good offers on the table potentially that you might never reach that $50 million threshold, and you sort of shoot yourself in the foot. But number two, we like to say engage us ideally 6 to 12 months out from a transaction. The reason for that is once you sign an LOI or a letter of intent, which is you clearly indicating your intent to sell your business, number one, there's not much time between signing that letter and the actual close. So purely from a time perspective, there's not much room for a lot of these planning, we would like to call it our wealth transfer toolbox, that really limits what we can pull out of that toolbox to utilize for you. Additionally, there are certain other aspects in that planning toolbox that if you don't do something further out in advance, or if you do something after you sign a letter of intent, the IRS might then say, well, you did this only after you explicitly stated your intent to sell your business. So we're going to treat this strategy differently than if you had set the strategy up prior to signing that.
So is that like as far as trusts and things you might do for your kids, college funds, and very specific things? Again, you need planning for.
Yeah, you need planning for it, but also, one thing to keep in mind with philanthropic intent. So, for instance, with what's called a donor-advised fund, you can transfer assets into this. It's basically a public charity where you can transfer assets into it. You get an upfront tax deduction of a certain dollar amount. And then anything that is sold within that charitable vehicle, you don't pay income tax on. So theoretically, if you contribute shares of your company to a donor advised fund in advance of the sale, but let's say the day before the close, and then you sell the business and you don't pay any income tax on the sale of those shares in the donor advised fund, the IRS is going to look at that and say, well, you clearly only did this for the tax benefits. So we're not going to allow you to escape tax, and we're going to tax you on a portion of that.
So in something in that example, how far in advance do you have to set that up to show the proper intent?
Well, definitely at the bare minimum before you sign the letter of intent. Then there's a whole lot of other elements at play where, because you're giving up control of those shares, so you no longer own those shares. So that's something you have to be considerate of as well. So, we're not, which I should have mentioned earlier, we're not tax or legal advisors, so we don't provide official tax or legal advice. But working with a CPA who understands that, has a more thorough understanding of that, can more closely advise you as to, what the IRS might look upon favorably or unfavorably, but also what that timing should look like.
Got it. So we covered the top two things. What's the third thing that people often mess up when selling their business?
It kind of goes back to what we mentioned earlier, the team. Obviously, I'm a little bit biased with being a wealth advisor, but let's say you work with, Joe Smith at this small registered investment advisor firm that you've known for, many, many, many years. And they've done great for you, for your family, but it's really pretty basic stuff. Well, we created this business sale planning checklist, which I can share, that really basically has a bunch of questions and items to consider before, during, and after transaction. And if your wealth advisor is not proactively asking you each of these things and reviewing with you each of these different questions, what your core capital is, which is what we call how much money you need today to to sustain your lifestyle throughout retirement. And anything above that we call your surplus capital, where you can earmark for philanthropic planning or legacy planning, understanding the structure of the business, but also being able to analyze different possible offers and structures of different offers. If your wealth advisor isn't taking a deep dive, most importantly, proactively about that, it's time to look for someone else.
My two favorite words today are surplus capital. So if you want Dan's checklist, make sure you reach out to me and I will get you the checklist. So DM me on all of my social media platforms, just the word checklist, and I'll send it to you. So what does it look like if someone is thinking about exiting? Obviously, they didn't do it yet. They're not signing letters of intent. They're in the planning stages. You happily get them in advance. They want to engage you. What does that look like?
Yeah, another really good question. And let me take a step back before I kind of delve into that. So, at Bernstein Private Wealth Management, there's about 200 to 215 folks like myself who are our wealth advisors. We have a separate group within Private Wealth Management that's called our Wealth Strategies Group. And that group is made up of former accountants, tax attorneys, investment bankers, international tax attorneys who have decades of experience within their respective industries, but no longer practice. Because like I said, we don't provide any legal or accounting advice. I would say we provide legal accounting information and work closely with our clients and other professional partners. Also within that group sits our family engagement team. And what that team is, it's a group of dedicated professionals who all they do day in and day out is they work with our clients and prospective clients as well to really take a deep dive and understand what their priorities are, what they're looking for, what they're hoping to accomplish with this newfound wealth. Why do they want to sell? What's their relationship with money? Not just the basics of where your investment objectives are and your risk tolerance. That's like the bare minimum fact finding. This is a much, much, much deeper discovery where we actually do certain exercises that have been really, really interesting to see, where we've had actually a husband and wife on either side of the table. And we have this deck of cards that lists 10 different priorities of legacy, philanthropy, lifestyle, risk, education for children. And so we'll give each of them a deck of cards and ask them to stack rank 1 through 10.
Prioritize.
And keep it to themselves. And then once they've stack ranked it, we'll say, okay, now let's share, ideally if we have time to share all 10, but let's start with the top 3. Because if you have a husband who had philanthropy as number 1 and a wife who had philanthropy as number 10, or a wife who had legacy planning as number 1 and a husband who had that as number 10.
What about a husband that says fancy cars number 1 and a wife that says fancy purses?
Yeah.
Maybe at least they're on the same page with that.
No, but I mean, it's such an important way to start, because that's really how we feel we could add the most value, to really get to understand our clients on a much more deeper, more meaningful level, because only at that point can we actually go through this wealth forecasting analysis, which I mentioned, which is our proprietary tool that we've built out over the last 30 years that allows us to, engage in this pre-transaction, post-transaction planning, that we can identify, your current financial situation, looking at different scenarios, whether it's different deal structures, different deal sizes, looking at different potential income tax or estate tax planning strategies, and create what we call this financial blueprint that allows you to pre-experience your financial future based on certain decisions you make today. And that's really generally where we start. So it's a very, very thorough process that takes time. And I hate calling this, but I tend to refer to those as our ancillary services, because we actually do not charge a cent for that.
Fabulous.
And it's selfishly for us to be able to get to know our clients again on a much more deeper level, so that only then, once we know what's important to them, what they value, what different buckets of financial capital are geared towards, only then can we create a very, very, very customized, highly tailored investment solution to execute on that plan.
So you're here at the IFA show. So you're here because you're mixing and mingling and hobnobbing with franchisors, some franchisees that are very successful here. Tell me a little bit about that. This is your first time here.
So this is my first time at the IFA convention.
And I encourage this.
Yeah.
For the audience. I made him come.
Yeah, no, it's been great, because as a firm, we've always had this business transactions group where a lot of advisors specialize in this exit planning, working with business owners who are selling their business. I sort of developed this niche over the last couple of years of working explicitly with franchisors and multi-unit franchisees, because what I've seen over time, and I've seen this week here at the convention, there's such a wide disparity.
What do you do? How can you help me?
Yeah,
there's somebody that does that.
And there's such a wide disparity of what the knowledge base is, where you have some folks who are more financially sophisticated, but also tax sophisticated as well, versus others who have no idea. And so my goal is to be an educator, a mentor, and to explain, the difference between income tax and estate tax, for example. To me, that's something that's very clear, but to many, 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 many other people, all they hear is tax, and they get like, oh, I don't like that.
Well, share that.
Yeah, so overly simplified. Income tax is, let's say you sell your business for $20 million. You don't get to keep that whole $20 million. There's what's called your cost basis, or what either you bought for the business, your purchase price essentially. And then there's a profit. So let's say your cost basis for the business is $10 million. You sold for $20 million, you made a profit of $10 million. Well, the IRS is going to tax you a percentage of that profit. There's two different tax rates. There's ordinary income and long-term capital gains. Long-term capital gains are things you have owned for over a year. Ordinary income is like wages and salary, but other things that you've sold that you've owned for less than a year. And the top federal tax bracket for long-term capital gains is 23.8%. Additionally, depends on a state-by-state basis, states will also charge you, long-term gains tax. Look, municipalities will do the same. Florida, obviously, as an example, is one particular state that has no state income tax.
And California, on the other end of the spectrum,
has the highest. So, that's, very simply income tax. Now, estate tax seems a little bit more confusing, but hopefully this will distill it a little bit better. So each individual is allowed to give away a certain amount of assets as a gift, either during their life or at death. And that's based on particular tax legislation that had been passed via Congress. Right now, that amount stands at just under $14 million per person. So $28 million per couple. Some states have their own estate tax, which actually California does not, believe it or not. And
they have enough taxes.
It's plenty of other taxes to make up for it. But let's say, you as an individual, you passed away with $20 million of assets, liquid, illiquid, whether it's a home, a business, anything.
It'll be a little more than that, but that's okay. We'll round down.
There you go. We'll round down. But you would then owe a tax on the excess. So if that $14 million, just using a round number, 20 minus 14 is 6. So you would owe a 40% tax on that $6 million if you did absolutely no planning and those assets were owned in your name owned. So that's really the difference between the two. And there's various ways we can mitigate income tax before, during, after sale, as well as estate tax by making sure you have the right structures on your personal balance sheet in working with the trust and estates attorney to, ideally when you pass away, have you pay the smallest amount of estate tax possible.
Yeah, and the key advice here is that you need to be prepared. It's just like doing your taxes. Hopefully you're not doing them yourself. I mean, if it's very simple, then obviously you don't enter into this conversation yet. But if you have a business and you've been successful, you have to plan or plan to pay.
Yeah, and I will say one of the things to that point, there's a lot of folks who feel like they can do it on their own, whatever it is, because it's cheaper, whether it's wealth management, whether it's income taxes. I like to use the joke that I'm not particularly handy. So if I were to run the electrical wiring through a house I was building, I'd electrocute myself. That would be terrible. I am paying someone to do that for me.
Yeah.
Same way I don't do my own taxes. I have a CPA that I pay to do my income tax because that's not my specialty. It's not what I want to spend my time doing. So a lot of folks will actually say to me, why should I hire you? Because I can do this on my own. And that sort of breeds a really interesting conversation where I honestly start with, okay, well, what do you do with your time? What's important to you? Because at the end of the day, the reason I have a job so I can work with you in looking after your investments and your wealth so that you can focus on the other stuff that's important to you, spending time with your family, traveling, golf, what have you, so that you don't have to deal with this.
Yeah. With a big win, a big exit, comes big responsibility, because if you're not planning, you're just going to end up paying.
Yeah.
And unfortunately, people pay unnecessarily. Can you share one story of kind of a before and after, like, someone that was going to exit for $10 million, $15, $20 million, and really could have not been prepared, but in this case, she and her spouse, her husband, were prepared, and they saved by doing certain things? I mean, is there an example you can run us down?
Yeah, without getting into details, because obviously confidentiality is of most importance.
Of course.
In my business, as it is in yours.
It's Joe and Sue.
Exactly. Joe and Sue. And we've actually, it's funny you say that, we write a bunch of articles and case studies, and we get a little bit corny. We just wrote one called Take the Money and Run. It's a play on Steve Miller Band. It's Billy Joe and Bobby Sue. The two characters that we use in that one. But super high level, essentially you have a business that is C Corp or an S Corp. There's a structure of the business and you own shares of that. Let's use an S Corp, let's say, because that taxes flows through to your personal tax return. So if you, again, go back to the example earlier, but even more simple, if you had Apple at $100 a share, you bought it at $10 a share, sold it at $100 a share, you owe tax on that $90 profit. That would flow through from the S Corp to you. Now, if you took a couple of those shares and put it into a trust for your kids, or put it in a donor advised fund where you get that upfront tax deduction, and then when you ultimately sell some of those shares, you don't pay any income tax on that sale. That basically allows you to reduce your personal income tax. But before we do any of that, again, going back to what I said earlier, is we have to start by understanding what your core capital is.
Yeah.
Because we don't want to give away too much.
Yes.
Because we don't want you going to your kids needing a loan from your kids, right?
Yeah.
We want to know, how much do you need to fund your lifestyle for, whatever you spend, $100,000 a year, $500,000 a year. You want to buy a boat. You want to join a new golf club. You want to buy another house. Understanding, because you've worked so hard for this journey where you've gotten to, hopefully a successful transaction. You should treat yourself.
Yeah.
You deserve it.
And in that example, was it? And we're talking fictitiously. In that example, is it? The classic trust fund, college fund, gifting, a combination of all of the above?
Yeah, a combination of all the above, because, this particular example, this family, they were serial entrepreneurs, and that was a value that they wanted to instill in their children. So they want to establish trusts of a certain size so that their kids could start their own thing one day, because that was something that was near and dear to their heart. That was really important to them. And that was, because we were able to go through those exercises of understanding, what do you want to do with this money? What's important to you? What do you value? We were able to kind of tease out that they wouldn't be upset if their children weren't entrepreneurs, but they felt fortunate enough that they had the ability to set them up to start their own business if they wanted to.
So Dan, if somebody's listening and thinks maybe they aren't prepared and they do have a team, the best news is you can still help them, right?
Yeah. I mean, the best news for me is I'm glad you feel that way, but, I like to equate it to, God forbid you had a serious health issue, right? You go to a doctor who specializes in whatever that issue might be. You might get a second opinion. You might get a third opinion. To me, this is no different, because, as I mentioned earlier, we do not charge a cent for this planning. Despite how crucial it is, we do not charge anything. It is non-committal. It's not a quid pro quo where we do this planning, you sell, and you have to hire us to manage money. There's literally no skin off your back for engaging us in this planning to get a better sense of, what your wealth journey is going to look like. So I would just say, the more perspectives, the more information you get, the better, because as a business owner, at the end of the day, you're only going to make a decision that you feel that you are as well informed as physically possible on.
Yeah.
And this is absolutely no different.
And I have a perfect example. My brother who's in Malibu, has a big business and a great house in Malibu. And it was prior to the Malibu fires 6 or 7 years ago. I'll never forget when my dad was alive, who was on Wall Street. Dad called me and said, "I just called your brother." I said, "My favorite insurance guy is going to be on the West Coast. He needs to re-quote his insurance and make sure he's covered." My brother's initial reaction was, "Nope, I'm good." My father said, "You dummy, you're not listening. He's the best insurance guy that I trust." And my father was also licensed in insurance. But to your point, this guy was the expert. So my brother allowed it, and he saved the money, upped his catastrophic insurance for very little premium. And guess what happened to him? His house burned to the ground. And my brother was very well prepared. And that's what this is all about. Being a little Boy Scout, Girl Scout, Cub Scout, whatever Scout. I think it's Scouting America now. It's not even Boy Scouts anymore. But so your final thoughts, final words of wisdom for the audience today.
Yeah, I would say it's never too early to think about an exit. I speak with business owners at various stages of their business life cycle, even back of the envelope, back of the napkin kind of business plan. Just even and you don't have to as early on know exactly what your exit's going to look like, what your priorities are, because you're not going to build a business, sell it in 6 months. It's going to take years, and your priorities will change over that time. But it's always something I actually, at the convention, at a succession planning event, heard someone say something that I really liked was he keeps his succession planning documents in a file on top of his desk on purpose. And he looks through it every once in a while to ensure, okay, everything,
still drives.
Still drives with what he wants to accomplish. So point being is your goals and objectives are going to change over time. Your priorities are going to change over time. It's always worth thinking, okay, at this point, what's my goal? What do I want my exit to look like? What do I want to accomplish with that? And talk to me. I'm here for that. We only charge our clients once they actually invest money with myself through the firm. But there's so much more value add that as a wealth advisor who operates in a much more holistic sense that I can provide and walk you through different ideas, different thoughts, whether it's about the business or whether it's about what your goals and priorities are and how they change. It's something you should always be thinking about. It doesn't have to be front of mind, but you shouldn't start a business, wait 10 years to think, okay, now I have a successful business, what do I want to do?
You work too hard, you got to protect it.
Exactly.
Protect the family.
Yeah.
Thanks, Dan.
Absolutely. Thank you.
So great seeing you.
Likewise.
If you're ready to talk about franchise opportunities, hit the link below to schedule a call. My services are free, and don't forget to like, comment, and subscribe. Thanks for listening.